Hello, good evening. Thank you for coming along to Barnard's Inn and Gresham College to hear my fifth lecture on developments in monetary policy. As you know, I'm the Mercer School Memorial Chair of Commerce at Gresham College. And what I've been trying to do in these lectures is develop a history, in a sense, a history of economic thought as it's applied to monetary policy. And in the last lectures, we've thought about money in a primitive sense. We've thought about the development of theory and stabilization policy during what's called the Great Depression. Not clear to me that it was such a Great Depression in the UK in the 1930s, but anyway, considerable theory was developed at that time. We then looked at some of the problems in trying to apply theory in reality in the 1950s and 1960s. We then went on to think about how monetary policy theory developed to deal with people's expectations, rational or otherwise, the extent to which human societies learn, and because they learn, policymakers have to adapt and decide the extent to which they want to use rules or discretion in order to bring about socially preferable outcomes. And this ended, as we discussed in our last lecture, with the adoption of inflation targeting. And many people lauded the development of inflation targeting as, and I'll borrow a phrase that I used in the last lectures, arguably or possibly the end of monetary history. Had we arrived at a point from which we needed no further development or evolution? Was it a point that would not lead to any problems, not lead to any more terrible outcomes for the economy? Those hopes were a little bit confounded from the events that have been happening over the last 8 years. And so the title of today's lecture is, let me get this right, yes, where did the great experiment go wrong, or where the experiment went wrong, indeed. Get my tenses right. I'm not going to today present an ex post rationalisation. I'm not going to stand here in 2015 and tell you all the things that we now know went wrong. I think that would be unfair on the contemporaneous debate. So as far as possible, I'm going to concentrate on that contemporaneous debate and tease out the ideas that policymakers and theoreticians, and in one or two places, even my own work, I'll leave it to you to work out where my own work draws upon. If anyone wants to email me and tell me which pages refer to my own work, I'll be happy to give them a prize at the next lecture. You can work that out. And I think policymakers, very much by the popular press, some of the popular press which is in pink as well, have been critical of policymakers, accusing them of complacency. I think if you follow the debates and you think of the complexity of the options faced by policymakers, very easy and very quick to understand there was no complacency. There was an intense, prolonged and difficult debate about how inflation targeting might be changed in the face of financial frictions or financial factors, whether it was sufficient and whether there ought to be some way of controlling what was clear to many people was an increasingly fragile financial sector. So let me at least come to some defence of our policymakers there. There are some criticisms I'll have later on, but we can come to that as the lecture progresses. So the canard that policymakers had left themselves with after the great inflation failures of the 1970s and 80s was the question of whether inflation was a sufficient statistic to stabilise the economy. If we stabilised inflation, were we stabilising the output gap? Were we stabilising financial and macroeconomic imbalances? Was that enough to ensure the business cycle would be stabilised? Or was there something else that we might be missing? Now, in most of the theories of inflation that we've looked at in this lecture course, inflation is some function of the output gap. And just to remind you what that is, that's some difference between the level of demand, aggregate demand in the economy, consumption, investment, government expenditure, exports minus imports, relative to its supply potential. So that's the factors of production added to their level of productivity. It gives you some notion of the potential. If there's some difference between those, most theories at the macroeconomic level think there'll be some inflation that may result. So if inflation is forward-looking, which we had in the model that we looked at last time, what it amounts to is a forecast of the current and future set of output gaps. And if inflation is stable, then what it boils down to is the statement that we expect future and current output gaps to balance each other so that our expected positive level of output and our expected negative level of output relative potential balance and at a zero. So there's no inflationary pressure. So just think of it as some constraint that's operating over time. We're setting inflation, we're looking at the sequence of output gaps. Sometimes they'll be positive, sometimes they'll be negative, but the sum of them is zero. If the sum is zero, there's no momentum or pressure for inflation to change. So in that sense, if inflation is just measuring output gaps and output gaps related to financial, monetary and real imbalances, maybe inflation is a sufficient statistic. Indeed, even if it's very hard to judge the level of capacity to demand in real time, do we know today, in 2015, what is the level of spare capacity in the economy after arguably a recession that's lasted half a decade? I'm not sure anyone will be able to tell you exactly. It's very hard to tell anything even about the recent past, and very hard to say anything about the current situation or current state of nature. So even in a world of forward-looking agents, policymakers have the problem of trying to work out what the level of output gap is, and they may make errors in it. And those errors, of course, would lead to the incorrect level of interest rate and arguably some perturbations in the economy as we learn over time what the true level of demand was relative to capacity. But that's not a good argument for persistent errors or persistent inflation deviations or persistent financial imbalances. Over time, we would expect the state of the economy to be revealed, and we'd have a good idea of where we were, and we'd be able to correct the economy accordingly. And indeed, when we looked ahead in this period and we looked at people's expectations of inflation, so what did they think inflation was going to be next year, the year after, or indeed in 10 years' time, those are mostly stable. Now, just because we as participants in the marketplace think inflation is going to be stable, that doesn't mean the policymakers can just go off to the beach and have a good time. In fact, policymakers should never go off to the beach, in my opinion. They should always be in the basement in Threadneedle Street working hard. What it means is, if we think inflation expectations are stable, it means that we expect policymakers will do the right thing if shocks come along, set interest rates at the right level to offset the impact of those shocks on output gaps and hence stabilise inflation. But note, if we go back to our forward-looking argument, if we think inflation is stable and the sequence of output gaps equals zero, that doesn't tell us exactly what the output gap path might be. Indeed, stable inflation expectations in the noughties may have been telling us that the current level of output gaps were positive. We were running at more than full capacity, and the inflation was stable because those really smart agents had worked out we were going to have a long recession at some point in the future. Now, I don't really believe that, but no doubt someone's writing a paper along those lines at this very moment. I look forward to refereeing it. Now, there was a heavyweight debate on the role of asset prices and financial factors for NKITs, New Keynesian Inflation Targeters, just to tell you what NKIT stands for. NKITs, which also happens to be the name of my nephew, so that's right, approximately. He'll like that. So the point was, we understood that financial structures may have been building a risk to stability, but we hadn't quite worked out how we were going to deal with them. This dragon was growing larger on the fat of this business cycle, but we're a week after St. George's Day, we hadn't had a St. George worked out how to slay the dragon. And indeed, some would argue there was no political will to slay this dragon. It was providing taxes and providing growth and employment in the country in a way that, had we wanted to do something about it, we may not have found us able to do it, and indeed it might have undermined the credibility or the political wall that surrounded a credible Bank of England. So these are interesting questions to ponder as I go through the rest of this lecture. Let me start at the end point and end at the start point, or whatever. I can't turn that on properly. Anyway, the answer, actually, to the problem that the financial crisis revealed and was developing in the noughties had already been given to us by Andrew Crockett, formerly at the Bank of England, by this time at the Bank for International Settlements, who attacked the received wisdom. And the received wisdom, he says, is that risk increases in recessions and falls in booms. In contrast, he says, in 2000, it may be more helpful to think of risk as increasing during upswings as financial imbalances build up and materializing in recessions. So the arguments that were doing the rounds in the policymaking circles, in the journals and in central banks understood this problem well. Nevertheless, policymakers couldn't also avoid a little bit of hubris. We'd had an expansion starting in 1992, it continued, the longest expansion that we can measure in UK history. And our former Chancellor, in fact, indeed our former Prime Minister, at the same time as Crockett was warning that long expansions may sow the seeds of their own destruction in terms of risk, policymakers were suggesting that the inflation targeting regime with operational central bank independence may allow us to avoid the historic British problem. That is, the violence of the repeated boom and bust cycles of the past, that we establish the new monetary framework based on consistent rules, the symmetrical inflation targets, settled well understood procedures, bank independence and openness and transparency, and side by side with it, as important, a new fiscal discipline with again clear and consistent rules, the golden rule for public spending, well understood procedures, our fiscal responsibility legislation, and new openness and transparency, certainly. And this was an idea that was repeated again and again in the previous decade, that somehow or other, perhaps we discovered a key to ending the notion of boom and bust. What were these reforms that were introduced? Well, those of you who were paying attention in the previous lectures, you'll remember we talked about the policy ineffectiveness proposal. And that said, in a world of rational agents who are looking forward, they've already made plans conditioned on what they expect policy to be. Therefore, if we want people to change their plans, we have to implement a policy that wasn't expected by people when they first formulated their plans. In other words, we have to surprise them and continually surprise them if we want them to change their behaviour in line with our objectives. And the biggest surprise, I think, in the last 20-odd years in terms of monetary policy decision-making was the establishment of central bank operational independence following the incoming Labour government of 1997, 18 years ago, and 4 general elections ago. I couldn't help thinking about this this week with an election ahead next week and kind of wondering what surprises our new leaders may foist on us in the weeks that follow. I wonder, maybe not a lot. But it's worth bearing in mind this incoming Labour government, prior to the election, had said the following in its business manifesto. It said, we propose a new monetary policy committee, fine, to decide on the advice which the Bank of England should give the Chancellor. No mention at all of operational central bank independence. And that, of course, is where the central bank is charged with meeting a goal set by the political masters in its own way, setting interest rates in a way that it wants, not having to advise the Chancellor. You'll remember, of course, that from the inception of the inflation targeting regime in October 1992, where the initial target was a 1 to 4% band for RPI, 1 to 4% band in the same way as some of you may recall, we used to have monetary targets that were always a band, because you can't hit them exactly, you have a band, and that's why we went for an RPI target. And that was not operational independence, that was an inflation target with a decision made by the Chancellor. You may remember the monthly Ken and Eddie show, which wasn't a TV programme for the younger people in the audience. It was the Chancellor meeting the Governor at Great George Street and generally ignoring his advice. So, incoming Labour government on a Thursday, there's a bank holiday on the Monday. The Governor, Eddie George, goes over to Great George Street to meet the Chancellor, Gordon Brown, to give advice. Didn't come back for a very long time. We were slightly concerned as to what might have happened to him. What had happened is that they decided to grant the Bank of England operational independence to pursue the inflation target with the Monetary Policy Committee by choosing interest rates in its own terms. And the Governor said shortly afterwards, I was very surprised by the timing, the decision to move on independence immediately on taking office. Remember, the likely incoming government had had discussions with the Bank of England prior to the election. So the bank had a reasonable view of what might happen, and the reasonable view didn't seem to encompass the view that there would be operational independence. The markets believed that the politicians would not let go of the decisions on implementation of monetary policy, and this was damaging. What was damaging was that the politicians wouldn't let go, not the implementation of monetary policy. It meant that inflation expectations did not adjust to the extent they might have done to the decline in actual inflation. So there was still some inflation bias, some uncertainty attached to the political will of attaining low inflation year after year, business cycle after business cycle. Because of that, the markets extracted a higher premium for debt than it would otherwise have done so. The impact on expectations is shown by the fact that bond yields dipped 50 basis points, which was a very large shock in standard deviation terms, on the announcement by the incoming government in May 1997. So first, it was a surprise. It wasn't priced in by the markets. Secondly, it was welcomed by the markets as it eliminated an inflation risk premium in the sense in which, because we were not sure how politicians would react to shocks and whether they'd stabilise inflation, when the markets were pricing debt at a longer horizon, they extracted a premium to compensate them for the possibility of an inflation shock over the duration of the bond. So, was this the appointment of a conservative? What I mean by conservative, someone who doesn't like inflation. I make no political statements in my lectures. Conservative central banker. Was it the appointment of an inflation nutter, in Mervyn King's memorable phrase? Or was it a solution to the problem of a credible commitment technology? Again, you'll recall from our previous lecture, if we don't have a credible commitment technology, we will always have a residual fear that the monetary authorities will try and impose an inflation surprise upon us. And because of that residual fear, we will always act as though it may happen, and that itself will tend to raise inflationary expectations. So which solution had we cobbled onto? Let me first tell you what happened to markets. The top line, or red line, are the bond yields up to 20, 25 years on close on Friday. So the day after, so the election's on Thursday, we kind of know the result Thursday night, Friday morning. My son was about 7 months old at this time, so I was fast asleep. I didn't know what was going on. I was sleeping at all at this time, so any moment I had to sleep was good. But so the bond yields, we can see where they are, and then we get operational independence announced on the 6th of May, and we see this very large jump across the term structure of around 50 basis points once we go further out. And I say that's a very large jump in standard deviation terms. And you can go away and model that. You can write down a model of what determines bond yields, and you can find out that this surprise and the fall in yields is completely consistent with a belief that because of operational independence, policy would be set in a manner that was more averse to inflation, or indeed set in a manner that where there wouldn't be surprises anymore to try and raise output above its natural level. Either way, you can get that kind of interest rate response. Okay. So, we're in mid-expansion. Expansion starts in 1992. We've got an inflation targeting regime, and then we've, in a sense, completed it with operational independence for the Bank of England. It gives a further kick, I think, to the economy. Let us now have a quick look at the economic record in the long expansion, which takes us up to 2007/2008. Previous lecture, we looked at output growth and inflation in this period, and we saw it was quite remarkable that year-on-year output, real output growth and inflation in this whole period was always above zero and always below 5%. Remarkable achievement for a 15 or 16-year period. Excuse me. But what we can also see, as well as actual outcomes, we can look at RPI and CPI inflation itself and expectations thereof, which I'll show you shortly. We can see that they were tremendously stable however you look at them, which suggests that there was belief or credibility in the regime. We'll go back to the definition of credibility. Having stated a target, which was an inflation target, people believed it would happen. If they believed it happened, they've got to also accept that the policymaker didn't have an incentive to change their behaviour. The policymaker didn't have an incentive to cheat or try a surprise inflation one way or the other. At the same time as this stability in the real economy and inflation, I want to point to fast growth in money and credit. Most of it was secured on property, which we'll look at. I'll give you a detour on whether that's wealth or not. And the backdrop to that large increase in asset price and that large increase in credit and money creation by the banking sector at this time was a lowering of global real interest rates. Real interest rates lowering means borrowing is cheaper, but it also inflates asset prices. Asset prices are, of course, the present value of the cash flows that you get from the lifetime of an asset suitably discounted, because £50 tomorrow is less valuable to you than £50 today. If the interest rate falls, the discount rate falls, the future cash flows are more valuable to you, the asset price rises today. And we see these effects. Asset prices rising may or may not be wealth, but they certainly allow you to secure your loans. In a world in which, when you go to the bank and ask for money, the bank doesn't really trust you, let's face it. You're going to turn up in your best suit, having brushed your teeth and cleaned your shoes, and telling them that you're a very good prospect. They've heard it all before. They're not going to believe you, and they're going to say, well, actually, what I really want is some collateral, if you're going to lend you any money. If asset prices have gone up, the value of collateral held by people rises, which means that lending or liquidity becomes more abundant. And we can see that in a large number of financial markets across the world, but also within the UK and the developed economies. So we see a transfer of funds globally from saver countries who had a propensity to save back to countries that were a little bit more impatient and wanted to borrow. And the collateral provided allowed those savings to flow from one part of the world to the other. So the macro stability was accompanied by an increase in overall risk in the system because the quantum of financial claims was increasing. Now, financial claims increasing, of course, places problems for both debtors and creditors. Now, a debtor may be at risk from an increase in financial claims because they may reach their lending limit. They may not be able to borrow any more, which then means if they face a temporary income shock, they won't be able to smooth their consumption. They will have to reduce it in line with the income shock. The other type of risk a debtor faces is that they may have to revolve or seek credit once again, and then they'll be facing interest rate risk because they don't know when they go back to the bank exactly what interest rate they may have to pay if they continue to be a debtor. So the debtor faces the risk that they may reach their borrowing limit, but also that the interest that they have to pay is unknown to them, so they face interest rate risk. The creditor, on the other hand, has had some savings. Why do they have savings? Why do they build up financial claims? Well, because later on in their life, or in the life of their children, they want to sell those financial claims and consume. So savings is just a way of deferred consumption. If their savings don't give them the return that they want, either because interest rates are lower than they expected, or there are defaults, or the loans, which is part of the same story, the loans were made to people who didn't pay it back, the creditors face risk as well because they may not get the returns that they expected later on in life, which would then constrain their consumption or investment plans in the future. So these are the kinds of risks that we run when we increase the quantum of financial risks in the system. Now, having told you the story, let's have a look at some pretty pictures. Well, I think they're pretty, and we'll see if you think they're pretty. So we can look at inflation expectations, forward inflation expectations 10 years ahead, by examining the relative prices of conventional yields, which are in nominal terms, and index-linked bonds that are indexed in the UK to RPI inflation. So these really are approximately forecasts from the financial markets of what people will think from 1992 to 2007, inflation will be approximately 10 years ahead. The line shows, this line here, shows the day of independence. You can see this fall from around 3.5% to just under 3% on that day. That's a one-day fall. Let's just give you an idea of how large the impact was of the independence statement. Subsequently, you can see that the inflation target was in RPI X terms. This is RPI, so there's some technical differences between the two. Essentially, one, RPI includes housing costs and X doesn't. But you can see it, broadly speaking, certainly compared to the previous history, reasonably stable long-term inflation expectations. Some increase towards the end of the period, again associated with housing costs, not necessarily to do with long-term inflation expectations. But again, reasonably stable view there about inflation over the long run, which drives us back to this point about credibility. And even at the end of the period, with some housing costs having come in, you're still below where we were on the day of independence. So you can think of this as a low period of inflation expectations, or stable inflation expectations consistent with the inflation target. There's a whole range of inflation expectations that you can look at over this period. These are two charts from 2000 to 2009, 1999 to, again, 2009. Various measures of inflation expectations, and the point I want to just suggest to you is that they're very stable. Some volatility here after the financial crisis started, but here very much in terms of stability, in terms of people's expectations of where inflation will be. Inflation expectations are in line with target. The regime would seem to be reasonably credible. Inflation at the time was, I've now gone to CPI inflation. Now, CPI inflation became the target by the end of 2003. That's this line here. You can see that over the end of the long expansion, CPI was broadly in line with this target, but it's certainly a tale of two indices. What I have here is goods sector inflation. Goods sector, manufactured goods, many of which an increasing fraction are coming from overseas, in countries in which labour is abundant, allowing the price in international currency terms in general to fall, creating negative inflation in the goods sector. And in order to hit a 2% target, you therefore need higher inflation in the service or domestic sector. You hit the target, but you hit the target as a consequence of these two things cancelling each other out. Now, the bank was mandated to hit the 2% target and write letters if it missed them by 1% on one side or the other. So it wasn't actually able to implement this target particularly flexibly. But some people have argued that this large negative shock to inflation actually imported inflation into the economy, because we had to run the service sector at over full capacity to generate sufficient inflation to hit the inflation target. And some people argue that in this period we should have had even tighter interest rates so that inflation was undershot, and explain the undershoot was being driven by overseas inflation. Now, I don't necessarily accept that argument, but later on I'll show you how that argument pans out analytically. It's an argument that was doing the rounds at the time. Now, whether having inflation 1% lower, which may in principle have very approximately required nominal interest rates to be 1% lower than they would have otherwise have been, the question for you is to think, would that have been enough to offset the asset price boom? Would that have been enough to prevent the large increase in financial claims that we saw? I probably think it wouldn't have been. But it's an interesting thought experiment nevertheless. Would it have been enough? Now, a lot of colours, a lot of lines there, so I hope it's not too difficult to see. But this is our long expansion period in grey. This is a paper produced by a couple of colleagues at the Bank of England, where they've looked at nominal GDP growth, that's real plus inflation, and then measures of broad money and credit. And you can see over this long expansion, relative to the growth in nominal GDP, which you can see is about 7 or 8% or 5 or 6% over this period, money and credit was growing by considerably more over this period. It goes back to the point I was making. There's growth in the economy, but alongside that growth in the economy, we have increasing levels of financial activity that represents itself in the creation of claims in broad money, lending in the broad money markets, and the creation of credit. In fact, on the margin, a lot of the commercial banks' funding requirements were sourced from overseas through wholesale and interbank markets. So this was providing impetus for the escalation in asset prices that we see in this period. I'll introduce that to you in a minute. So where were these overseas funds coming from, and what did they do to interest rates? So let's just concentrate on the left-hand chart to begin with. This is an economy. We have investment as a function of interest rates. As interest rates fall, on the margin, we're going to invest more. As interest rates rise on the margin, we're going to want to save more. So we've got a downward slope and upward slope. In the absence of an overseas economy, the equilibrium interest rate in this economy would be A, where the market for savings and investment would clear. The output gap would be zero. There would be no upward inflationary pressure. And asset and goods markets would clear at A. If, on the other hand, we globalise, we open up our capital markets to those from abroad, and that's the right-hand side. And at that interest rate A, we can see that because these global markets, in this particular case, have a higher propensity to save at that interest rate than we have, that will put downward pressure on our interest rates, because at this interest rate, we can see that there will be excess savings from abroad that will lower the interest rate here. At this interest rate here, we're going to have, at lower interest rates, an excess of investment. That's the banks requiring funding from abroad for the loans they're making to the domestic property market. And the level of savings will be below that level of investment. We're borrowing from abroad, so that's a current account deficit. There's a financial or overseas disequilibrium, and that's met by savings from abroad at this point here. The current account deficit equals the current account surplus from these economies. The excess of savings here equals the excess investment here, and capital is flowing from this side to this side, and lowering interest rates from A to C. This is the process that was going on at this time. Lowering of interest rates globally. And we can see this through this, I'll just say almost horrible picture, but I suppose it's telling us something. These are global long-term real interest rates in G7 or advanced economies with some standard error bands attached to them. You can see that essentially these real interest rates are falling over this long expansion period. I'm just going to go back a slide. Helps us understand, or gives a graphical depiction of this process, whereby we're getting more and more savings here, pushing this out further and further, which acts to further drive down the real interest rates, and as a counterparty to that, leads to increasing levels of current account deficits in debtor countries. So, credit and money is expanding faster than nominal GDP. Interest rates in the borrowing, or the market interest rates in the lending and borrowing markets, are falling. A lot of the funding is coming from overseas markets who are saving. So in a sense, the financial industry is recycling savings from safer parts of the world into the domestic economy and leading to some form of credit boom. And the banks themselves are able to do this with very little capital at stake. This measures, gives us an idea of the ranges that were involved at this time. You can see some very high ratios in terms of gearing for banks. So a range in the UK of banks of 20 to 60 times capital in terms of their loans. So the median bank is somewhere between 20 and 40 times geared. So they're putting very little capital at stake and able to circulate those savings from abroad, bring them in to the UK and lend them within the UK market. What did that do to house prices? Well, I think we know the answer to this. House prices almost tripled over this period. This is some data from the ONS. We have the average house price, oh happy days, 50,000 odd, 1992, and here we have 2006, 2007, well over 200,000, so perhaps a tripling of house prices over this very long period. Credit supply expanded. We can see as well that wealth is being acquired. This is the net acquisition of financial assets. And over this period as well, some liabilities. So there is first a period of wealth acquisition, which is greater than liabilities. In the second half of the period, that reverses itself. So in balance, there doesn't have seemed to be an impact on net worth. And in fact, we can even ask ourselves whether changes in house prices increase our wealth. That would seem to be obvious that it does. But let's think about this from first principles, whether this recycling of credit and the creation of claims on each other that drove up house prices was making us wealthier. Now, I want you to imagine an individual who lives for 3 periods. This individual has an amount of income in every period and an amount of expenditure, but they save £50 in every period. So we can just put that in as a net asset. In the second period, they buy a house, and in the third period, they sell it. So it's just simply, we're just going to go through a life cycle example and try to understand what happens to the wealth of this individual. Well, in my first period, I got £50. In the second period, I get another £50, but I use £50 as equity. So this is my savings S, £50 is my equity. And I take out a £50 loan from the bank to buy my house, which cost me £100. Those two together. The third period of my life, I save another £50, and I use the £50 to pay off my debt. So I have £100 of equity and £50 of assets, and I end my life with £150 of assets. Actually, on reflection, that doesn't sound very rational, but perhaps I want a very lavish funeral. Let's think of it in those terms. Okay, fine. So the sum of my assets is simply equivalent to the sum of the savings that I've made over my life. The house price purchase didn't affect it one way or the other. It was just something that I bought when I was middle-aged. Here. Now, let's go through the same exercise, but let us suppose, for some reason, between periods 2 and 3, I buy the house for 100, 50 plus 50, but the house price doubles rather than triples. Now, again, what determines a house price? It's an asset. So the house price must equal the present value of imputed or actual rents that I'm going to get over the lifetime of the house, appropriately discounted as well for any risk. Think of those as the insurance premium you may pay, or against fire or subsidence or something else that may happen to the house, and any growth in rents that you may get over the lifetime of the house. That would give me an approximate pricing model for a house. So if the house price has doubled, that may be because rents have gone up because housing is scarce, and or real interest rates have fallen, that raises the present value of the cash flow that I get from the rents. So the house price has doubled. And now, luckily, at the end of my life, now I've got 200, the 50 plus the 100 plus the 100 that I've saved, so 50 plus the 100 that I've saved, plus another 100 from this exogenous shock to house prices. Now I end my life with £250, which means I can have an even more lavish funeral, or I could donate some of it to an academic institution, whatever I want to do. Perhaps the two could be combined. Now, I'm going to add another household. So this is an overlapping generation story, and we can, or another individual rather. So the first individual was born in T1, the second individual is born in T2, but they go through the same life cycle story as this individual here. So this individual is saving £50 in their first period of their life, and in the second period of their life, their £100 is actually going to the first individual. That's who they're buying the house from. And indeed, this person, had we started the story at t equals 0, we could see would have bought the house from someone who 1, 2, 3 is now dead, unfortunately. Anyway, that's the way life goes. So what we have now is a generational issue. You see that the £100 here has been provided by the savings and the debt taken on by this younger individual who was born a period later. They're left with 150, 100 of which comes from this guy, and this guy has got £100 of assets in the second period of their life, just as this guy had here. So, all seems well. Now, is an increase in house prices wealth? Well, if we only had one individual and there was some magical exogenous increase in house prices, we might think the answer was yes. But now, let's go back. All we've done is I've said, look, the house price has doubled. Right? So these chaps now have, this chap here now has £250. But their £250 of wealth at the end of their life is compensated for by this guy here now having to have £100 extra of debt in order to provide the £200 that they required. When we aggregate across these two individuals, there's no effect. In effect, the increase in the house price is a distribution of wealth from those who hold housing, are long housing in terms of financial markets, against those who are short housing or trying to buy housing. And indeed, in Tier 3, I could add another individual who's born in this period, which would be a young person, this would be a middle-aged person, and this would be an old person, and we could think of this whole vertical line as a family. So the change in the house price is nothing more than the distribution within an economy across a family. So can we please stop talking about it at dinner parties? Okay. So when we see charts, this is one from the Bank of England that shows a relationship between house prices and consumer spending, what we may actually uncover if we look a little bit deeper is that it's to do with people being able to use housing to smooth income shocks. Think of a world in which my income has temporarily fallen. If I can use my housing as collateral that allows me to maintain a level of consumption until my income rises again, it might help explain the correlation. It's not that it's to do with permanent income or wealth. Where are we going? Okay. Now, the inflation targeting argument was formal independence under inflation targeting a manifesto for inflation nutters, people who hated inflation, or an optimal rule, something that brought the economy close to something that society could choose if it wanted to, something that it wouldn't want to move away from. But how could we deal in this world with escalating asset prices? Well, there was a BIS view that the monetary policymaker, as well as reacting to inflation and output, should also think about reacting to house prices or asset prices, such as equities, when they change interest rates. In effect, they should act to prevent or prick bubbles. And there are plenty of examples in emerging economies where there are capital controls, foreign exchange interventions, and other such things that essentially acted to control the financial sector in a way that we moved away from with the abolition of capital controls in 1979. The orthodox view was that simply you can make inflation targetry flexible, and I'll explain what that means shortly. There was at this time little discussion on direct regulation, on what has subsequently been known as macroprudential instruments. So let me sort of go through very briefly where we think we were with the adoption of inflation targeting. And that was, we'd adopted a world in which we'd tried to stabilise output inflation with a well-understood interest rate reaction function and judge those outcomes in terms of output and inflation variance. Now, for the reasons we talked about in the previous lecture, optimality or a rule may not be credible because we may think that in the absence of commitment technology, the policymaker may change their behaviour over time. A couple of ideas in the literature, one from Rogoff and one from Carl Walsh, was that we could have a better outcome by appointing a socially conservative person, and by conservative I mean someone who doesn't like inflation. If we believed in him or her, that would help offset some of the problems that would otherwise occur in a world of discretion. Or we could go even further and impose a financial penalty on the central banker. We could say to them, we'll fix your salary in nominal terms or your pension, and if you miss your inflation target on the up or the downside, we're going to take away from your pension or your salary. That would pin them down, wouldn't it? That would get them to behave, we think. Of course, that then may lead to them becoming an inflation nutter, someone who only cares about inflation and doesn't try to offset temporary shocks to output that may be caused by asset price fluctuations. So that may not be optimal. The idea then was that by having an independent central bank that was transparent and accountable and made ex-ante claims about where inflation would be, we would always be there to assess its ex-post outcomes. And because we'd always be there, pointing at them if they got it wrong, This would tie their hands and force them to hit the target and stop reneging or stop misbehaving at some point in the future, because we could always point to them and say, you're supposed to hit that target. And the NPC members will tell you, they have to do it. It's in the law. That's their mandate. Now, central bankers may argue they don't need that kind of assessment. Under mystique, or monetary mystique, we can trust them to do the right thing because they're policemen or policewomen of the social norm. But I prefer a world in which we can watch the guards, a sort of panopticon view of credibility. I'd rather watch them, see what they're up to, and ask questions when I think they're doing things that I worry about, rather than quietly let them get on with things. Now, I was going to talk a little bit about how the gold standard provided a form of credible commitment, but I don't think there's going to be time. It looked to the transcript for a description of how that worked. And I was also, well, no, I've probably got time to talk about that. So I'm going to, that's the gold standard bit. So imagine I've talked about it. We'll go on to here. Now, one of the, so it could very well be we ended up with inflation targeting and independent central bank in a world that was pretty close to the optimal. Good. But people being what they are, economists being what they are, we kind of wanted more. We wanted to go even further. I don't know how clearly this line has come up, but there were two further developments in terms of transparency and accountability. It may not only be the case that we want to assess policy after the fact, it could very well be the case that if we understand what the policymakers are going to do, because they've explained their reaction function, if we observe the same world as they do, we could already have predicted what they're going to do when they do it. So you got into this interesting trap where policymakers were saying, if when we do things, the market doesn't move, remember in the past it was all about getting the market to move, if the market doesn't move, we must have been doing the right thing because the market had already anticipated what we were going to do. In that way, the lack of a market response was proof that they understood the reaction function, that the people out there understood the data, they understood the economy, and therefore they had already worked out what the policymaker was going to do. By already working out what the policymaker was going to do, they had assumed that the policymaker was going to act, in the words of Michael Woodford, in a timeless manner, in a way that was always going to be the same, was not going to change because there'd been a very large recession, or there was an election on the horizon, or the central bank governor wanted to get re-elected. They were going to behave in a consistent manner. That's the idea of timeless policy. So people started looking at the errors of policy, and it hasn't come up so clearly, for which I apologise, but maybe the easiest way to see this is data from the United States, the FOMC data, and in the final chart here you can kind of see the 90-day error. From federal funds futures you can look at what people think the policy rate will be in 3 months' time. And the pre-94 error, you can kind of see is large. But after 1994, and increasingly so, the errors were very small indeed. And in fact, it's very, very tiny and you can't see it, but there was a sequence of 17 interest rate hikes from the FOMC from 2004 to 2006. And that's this line here. There was not a basis point error in any of them over this period. So completely was the reaction function understood. At the time, a lot of people thought this was a good thing for the reasons that I've said. We understand what the policymakers are going to do. On the other hand, it had a consequence that there was no interest rate risk, in a sense in which we had a portfolio or we were making decisions. We knew exactly what interest rates were going to be. Perhaps it would have been better to allow there to be some uncertainty, because in this world there always is. You can't completely eliminate uncertainty. And so it's a kind of microeconomic analogue of the problems of promising no boom and bust. The longer there's an expansion, the longer there hasn't been a bust, rather than people thinking the bust was more likely, which seems the rational thing to do, people started thinking a bust is getting less and less likely. They stopped pricing risk accurately. So even though the financial structure, for the reasons that we looked at, was getting larger and riskier, people were not observing that risk in financial prices because uncertainty was seen to be evaporating. So you had this disconnect between the financial pricing of risk and the genuine structure of the economy that was inheriting greater and greater risk. Some people even went further. They said, well, let's not have an inflation target, let's have a price level target. An inflation target tells you what the change in inflation is going to be year to year. A price level target tells you, I will tell you what the price index will be in 5 years' time. So if the index today is 100, I'm going to tell you in 5 years' time it'll be 110. And in 20 years' time, it'll be 120, or whatever the rate of inflation may be. And that was where we were going. And perhaps at that point, we started to over-engineer the problem. So thinking about the financial structures, we were thinking about how can we make this particular regime work better and better. We started thinking about inflation or price level targeting. So one argument. Anyway, so it's an interesting world we ended up in, to think about modifications of this regime rather than thinking about instruments that could have helped offset financial risk. The orthodox response to asset prices follows the following set of arguments. To the extent that financial prices provide information for future output gaps and inflation, we will use the information. If the monetary transmission mechanism, that's the set of financial prices and interest rates that are contained in the macroeconomy, changes, then the central bank's view of the neutral natural rate of interest will change. If we target asset prices, which are themselves a function of policy rates, it may be counterproductive. We may be offsetting what we're trying to do elsewhere. Think of it analogously as putting your foot on the brake and the accelerator at the same time. It doesn't help the car go at all. If we're going to worry about asset prices, we then have to pick bubbles. We have to know when the asset price is a fundamental or non-fundamental change. It's very hard to do in real time. If I could do it, I'd probably be a very wealthy man. I don't believe anyone who says they can tell the difference. If we are trying to offset asset prices, we might conflict with output and inflation objectives. If housing prices are doubling, how much higher would interest rates have to have gone to stop that happening? What would that have done to output and inflation? So there's an extra trade-off introduced. And if we do prick a bubble, the resultant crash is going to require a reversal in rates. So you're still going to have some impetus from the increase in rates as a crash, then you have to reverse rates. And again, you're going to have the same type of problem with your foot on the brake and the accelerator at the same time. So the orthodoxy was, suggested by Charles Bean, the optimal policy is in effect to ignore the asset boom, but to mitigate the fallout when it collapses. This was written in 2003. Furthermore, the expectation of looser monetary policy in the event of a future credit crunch raises expected inflation. Consequently, there's an upward bias to inflation today. So there's a potential upward bias to inflation because it was felt that the more likely an asset boom was going to be, the more, when it happened, you'd have to offset that by having looser monetary policy for longer. Now, Charlie Bean was smart enough not to necessarily say this is what would happen, but it seems pretty close to what the responses were. There's not a lot we can do to the credit boom, but once it happened, we'll act vigorously to offset it. It seems much more like it. So I'm now going to try to get to the end in time and understand a lot of the ideas that I've put forward to you in a couple of diagrams. I hope they're not too painful. I can assure that I drew them with my own fair hand, so any pain is shared. Now, if we have a policymaker who cares about inflation, and that's their target, that target there is also their bliss point, the point at which they have no losses because they're at target. The policymaker may also care about inflation variance or risk, and the extent to which a small deviation in inflation is the same as a small increase in risk, is the same as a small deviation in inflation on the underside. Their indifference curves will be a set of half concentric circles out here, where any point on here is equivalent. Whether I'm up on inflation or down on inflation, I'm equally far away from the target. And in fact, even if I'm at target, if I've taken on some more risk, that's the same to me as well, because I'm the same distance away from my bliss point. That's the idea here. Now, if the economic risk is some function of what the policymaker is doing with interest rates, If I have a low inflation here, and I want to get back to my target, C, I'm actually not going to go all the way to C, because that implies far too much risk, and I end up on a much worse indifference curve. I'm going to want to choose a point that minimizes my distance from the bliss point, which implies this point here. That would imply, in the context that I've talked about, an undershoot in inflation, but some relatively small level of risk. Policymakers actually possibly went to this point C. And that might be because they weren't factoring risk into their indifference curves. If they're risk neutral, any point along A is the same as any point along A here. Any point along B, in terms of risk, is the same as any point along B, because they're the same distance in terms of inflation. So the policymakers, if they're trying to get inflation back to equilibrium, may well have been increasing risk because they went up to this point here, C. And we ended up in a world in which risk was escalating. Indeed, we can also get the same result in a different way. Because let's imagine the risk is not in any way in the control of the policymaker. It's entirely exogenous. The policymaker may decide to hit this inflation point here, but risk in the economy through financial claims increases, and this thing is moving out over time as the expansion continues, and our notion of uncertainty starts to be underpredicted. And we end up at this point C again, where we have too much risk in the economy, even though we're hitting our inflation target. It's one way to think about the world we are entering into as the noughties progressed. One way we might have offset some of that was to think hard about monetary aggregates, think hard about, not in a simplistic sense that money drives inflation, but by examining money and credit behavior and the fact that it might be dislocated from interest rate policy because the quantity of loans was increasing, suggesting an increase in financial fragility, we may have thought harder about the kind of policies we might have implemented to reduce overall bank and interbank exposures. Of course, we've ended up with some thought on those policies now as we move towards macroprudential instruments. Models that we were using at the time were not in general considering these possibilities, and in general money didn't matter because it was pinned down as an equilibrium phenomenon. If it's an equilibrium phenomenon, it's not imparting shocks to the system. There's a quote here from some evidence given to the Treasury Committee in early 2007 before the crisis that talks about how money could be used, and particularly how the implication and developments in our measures of money may not fully reflect the impact of liquidity provision elsewhere in domestic markets, nor on the quantum of risk being run in domestic financial markets due to an increased role for hedge funds. So we would call for more work to measure monetary dynamics. A lot of people there were beginning to worry about the impact of financial risk on the operation of stable monetary policy. Well, thank you for bearing with me for the lecture. I'll sum up by saying that rather than having solved monetary policy problems, the noughties or the noughties threw up a whole new bunch for us to reconsider. The party that we had, it was a good one, I enjoyed it, had led to quite a large hangover, specifically in public and private debt. The near-optimal monetary policy that we thought we had not quite managed to formulate a plan for financial risk. That's the real message that I want to get across today. I don't want to get any sense in which I'm saying that monetary policymakers were complacent. I think we were, or they were, thinking hard about these things all the time. We didn't quite have an instrument, perhaps, for dealing with them. These problems were widely understood, but at the same time, agents' willingness to take on risks just seemed to increase, either because measured uncertainty in financial markets were falling, or because it had been such a long time since there had been a default, everyone started thinking it couldn't happen again. We had an absence of instruments to deal with risk, and perhaps even some willful neglect on the margin, possibly for political reasons that we talked about earlier on. The question of how we should deal with measured and unmeasurable uncertainty in the monetary policy game is the subject of my next lecture. Thank you for coming.